So let's talk about non-QM. What the heck is that? Don't you just love the mortgage business? It's like so full of jargon. Yeah. It's like, I always say it's like learning, a foreign language.
Totally. So non-QM stands for non-qualified mortgage. And that's just going to be the outside of the box types of scenarios, not the in the box, Fannie Mae, Freddie Mac, FHA, VA.
Right. And this was kind of defined through Dodd-Frank and as part of TRID, if y'all remember back, if you were in the business back when those things were coming to market and the FHFA. And so really kind of this qualified mortgage would be what Tara is referring to. This is going to be more mainstream financing with USDA, VA, FHA, Fannie Mae, Freddie Mac. Those are kind of fall into that qualified mortgage category. But as we all know, we have clients that have scenarios that fall out of that. And non-QM is really starting to pick up its pace in offering and expansion. So today we wanted to talk about 4 different kind of scenarios that could be helpful to our communities as we talk with potential buyers or even people that currently own a home, but maybe they had a life change and now they can no longer qualify under a QM mortgage and might pop into that non-QM. So Tara, lead us off.
All right. So the 4, I'd say the most popular, asset depletion, right? So using assets as your income to qualify.
And I think let's talk about that because it says asset depletion, that's actually a mortgage term. You're not depleting the asset yourself as a borrower, but from a lending standpoint, the guidelines allow us to take that asset and derive income out of it on the paper.
Yep.
To help one qualify that has a lot of assets. But let's kind of walk through the math of how that works, Tara.
Yeah. So there can be various, right? So Fannie Mae and Freddie Mac do have asset depletion, or utilizing assets for income, but their guidelines are very strict. Their calculations are very strict. So, and it may not give us as much income as we'd like. So in this non-QM space, I mean, you can do as little as just a calculation over 7 years. So if someone has $2 million and you divide $2 million by 84, that's your income.
Usable income to calculate debt to income ratio for lending purposes on that loan application. That's what we're referring to.
Right.
So asset or income is how I like to think about it. And again, there are some programs in the QM world, and there's a lot of programs in the non-QM world. Obviously, we always want to try to fit people into the QM world just because the terms tend to be better from just interest rate, cost, etc. But if they can't, then it's important to know that there are options out there. And sometimes it really becomes just an equation for that person. It's like, all right, so if I'm having to borrow at an interest rate, maybe a full point or a 1.5 above what a qualifying mortgage would be, after the tax deduction or things that are going on, what does that really net out to be? And many times people with those assets are also consulting not only their tax advisors, but their financial planners. And then we're all kind of collaborating on the strategy that makes sense.
Yep, absolutely. Yeah.
All right. Non-QM number 2. What do you got?
Number 2 is going to be more for self-employed borrowers, buyers, anyone out there that isn't showing a lot of income on their tax return. So not really showing, income on paper. Essentially, we know self-employed borrowers love to write off and deduct as much as they can to reduce their tax liability. So that can be problematic when needing to qualify for a mortgage. Make $100,000 a year, but you deduct down to $500. Well, that's going to be an issue. So the solve in the non-QM world is to look at bank statements. So anywhere from 12 to 24 months, we derive income from deposits.
So that would be the alternative. And again, when it comes to self-employed people, I think this is really important because, I've been doing this almost 28 years now. And seriously, what? I don't know. That won't go fast. But just over that entire 28 years, when we talk with self-employed people, there's always this kind of rub, right? It's like, well, gosh, if we show less deductions to qualify, then we have to pay more in taxes. We get it. The lending community gets it. Now, the QM world is going to take what's on the tax return for qualifying.
Right.
Now, there are ways, depending on the type of entity or the structure. For example, if somebody is filing a Schedule C, there's certain things in that section of the Schedule C that lenders can add back in, subtract back out to impact that bottom line. But I always tell people when I'm talking to somebody that files a Schedule C, go to line 31 of the Schedule C. That's the usable income. Now, we can add some stuff back in, but really, in Tara's example, if you've grossed $100,000 and line 31 on the Schedule C shows $1,000, that gives you some insight into there's a lot of deduction there or depreciation or things like that. Again, some things can be added back in, but it may not be enough to actually qualify according to those guidelines, which takes us into this kind of non-QM world. Now, back in the day, prior to all of the Dodd-Frank and all of the regulatory changes, bank statement programs were very prevalent, as was, no income documentation and stated income. I mean, it was a completely different world, which in part, I think, really did lead to what we saw in 2008 and people just overextending. So I do want to make a point to know that this kind of stated income or bank statement program of today is very different than what it looked like before, because it's not really stated income. It's just using a different documentation to derive income other than the tax return. That's kind of the different. Yeah. And I definitely want to make that point because so many people are now like worried, oh my gosh, this stated income. Well, it's not really stated income. It's bank statement derived income.
Right. And I think it's a good, this type of program, this one specifically, can be a short-term solution till you file your next tax return. And then you decide, okay, do I want to keep paying a higher interest rate for my non-QM mortgage, or do I want to show more income on my tax return, get into a QM, qualified mortgage, right, at a lower interest rate, but I got to pay a tax liability, right? Like there's a lot of ways to work it and utilize these products as short-term solutions if you need them.
Absolutely. And again, that's where working with, a strategic lending team is helpful, because then as the tax advisor is evaluating and the, financial planner is evaluating, then there's kind of be that four-pronged conversation to really determine what's best for that particular person. So, all right. So self-employment, you guys pop your questions in the comments. If you have questions, Danielle. Yes, hairdressers. That's a very common type of self-employed business. She's probably filing a Schedule C, and they have lots to deduct. So it could be a perfect example for a non-QM scenario. All right, what else we got?
So the third one, DSCR loans, if you guys are hearing about those. So debt, I always have to look it up, debt service coverage ratio. These loans are going to be specific to investors. So not someone purchasing owner occupied or second home, purchasing investment properties, and essentially utilizing rental income only to qualify.
I love it. I mean, it's so different. It's so out of the norm from a QM qualifying mortgage guideline. And so here, it kind of almost goes into a commercial type of underwriting approach. They're really looking at just what's the debt in relation to the rental income, and does that math work?
Right. So can be a very great option. Number 4, and this is a newer, it's been talked about, but really coming more prevalent, are ITIN, or programs for people who have an ITIN. So an individual tax identification number, and they don't have a social security number. So it's just fantastic, right? To be able to offer home ownership to more people in our country.
Yeah, it's really picking up steam. And certainly in the Southwest, there are so many qualified buyers that have ITIN numbers that don't necessarily have the social security number, and they are able to qualify. So this program allows for that. There's a lot of nuance to it. So we want to make sure that you understand down payment is more than you find on a qualified mortgage guideline. Interest rates are higher on that. And Jim and Danielle, I see that you were asking about interest rate difference on the bank statement program. Tara, I would say that's really driven by credit score. It's also driven by occupancy and down payment. So to answer the question, Danielle and Jim, but I would say on average, it's probably kind of a point to a point and a half higher in rate. Could be even a little bit more the higher the loan to value.
Right. And the lower the credit score. Right. So yeah, I was going to touch on after we talked about these, just that, minimum down is going to be like 10%. We're not going to have 3 to 5% down. Even if you're a first time home buyer, you are allowed to do these programs, but minimum down is going to be 10%. And obviously interest rate is going to be a big deal. Reserves, having reserves in the bank, not necessarily liquid reserves, that kind of comes into play. So there are going to be additional, restrictions or requirements with these programs.
Well, it's a risk-based program. So the terms is going to be based on the risk of the loan. So again, lower down payment, lower credit score, lower reserves is going to have a higher interest rate than somebody that's putting more down, has more reserve, and a higher credit score.
Yep.
So you really start to see that risk-based kind of lending approach come into play on these loans.
Yep. But great solutions.
They are great solutions. Absolutely.
Never discount anyone out there who thinks they may not be able to qualify. They think, I can't, I write off everything. There's no way I can qualify. Have them call us.
Well, I think too that it, realize just like when it comes to the real estate community, not all real estate agents are equal, right? I mean, skills vary, and not all lenders or loan officer teams are the same either. So I take pride in the fact that we have for many years, and Tara's been my loan partner for 15 years. I could be off. It could be 17 by now. I don't know.
Yeah.
Just feel something weird. So I don't count. Like long time. But we really do approach this as from a strategic standpoint. What are the buyers or the borrowers' goals? What are the obstacles? What are they trying to achieve? And then we get back to how we build out the strategy.
Yep.
And that's the exciting part of it. I mean, I don't know about you, Tara, but honestly, every day in our business is a new day because we talk to people, new needs and new scenarios.
Yeah. And collaborating with the agent, their financial planner, their tax advisor. I mean, it all comes into play. And a non-qualified mortgage may not be the best solution, right? But that's where here to help you figure out.
Right. And also know that, some of the big banks out there do not have non-qualified mortgages. Also, be careful because I fear, and I've seen this in the past, but maybe somebody talks to a lender, whether they have non-qualified or not, maybe they have the depth of the experience or not. But if they tell that your client, no, you can't qualify, I would always recommend a second opinion.
Yeah.
You have a second opinion with, just a team or a loan officer that truly has the depth that you need. So and your buyer knows or your borrower knows that, it has been vetted and here are the obstacles, and then here's the game plan on getting ready to buy. And I like to call that home ready, because our job is to get people home ready if in fact they want to purchase a home.
Yep.
All right. So Terry, you had one kind of scenario, and this is a real life scenario. We like to talk about these because this is real stuff. This is what we experience. And I think it really helps just to kind of bring the story to the forefront of, this was a call that we received, about 6 weeks ago. Walk through the scenario.
Yeah. So he and his wife are in their mid-50s. They were successful business owners and sold their business. I mean, it might have only been like a year ago. So sold their business and have $3.5–4 million sitting in various types of assets. So they wanted to purchase a new owner-occupied home in Arizona. They're moving from Tennessee. And, given that they were under the age of retirement, so under that 59 and a half, it becomes a little more convoluted on trying to figure out how we can get them qualified. They're not eligible for Social Security yet, no pension, nothing else, right? Because they were just self-employed and they sold their business. So really looked into that asset depletion or asset for income program. Fannie Mae and Freddie Mac require him to be much older, at least over 59 or
59 and a half. That's kind of like the line in the sand. So we knew initially when we were talking with them on that initial kind of high trust call that we knew that we were going to kind of get into the gray zone and probably have to get into the non-QM world. But before we got there, we really wanted to go back to underwriting, really comb through those guidelines. Fannie and Freddie, was there any way around the not being able to use their asset to derive income for qualifying?
Right.
And in their scenario, based on multiple factors, they were not. So what we do, Sarah?
So we went to researching the non-QM guidelines. And it's important to know, Fannie, the guidelines can change constantly. So it is something that's super important, like to us, to vet for everybody. Be sure we have 100% clarity for people going into whatever program it is. When you go out to start shopping for a home, we are 100% dialed in. You will close on that house. So, these types of non-QM programs can take us a little bit longer to vet, to go through. And so patience is definitely needed for us to maneuver. But went into the asset depletion non-QM world. And it was pretty simple. We had underwriting look at their assets. We could divide 3.5 million divided by 84, generated a boatload of income, and we sent them on their way shopping.
It is important to know in that scenario, debt to income ratio is still being calculated. Yeah. It's just being calculated off of the income that's being derived from the asset itself. And I think too, just back to your point, Tara, with regard to lending guidelines changing, how often? Really, we should track this year. I can't just know how many times I say or you say, let's check the guidelines. Yeah, on all QM stuff, because it is changing. It changes all the time. So what we knew last year, 6 months ago, 5 years, 10 years, doesn't matter. No. It is a new day, and those guidelines change. They're constantly in motion.